Ladies and gentlemen, good day and welcome to the Windlas Biotech Limited Q1FY22 Earnings Conference Call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. If you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Windlas, Managing Director, Windlas Biotech Limited. Thank you, and over to you, sir.
Good afternoon, everyone, and a very warm welcome to all of you present on our first post-results conference call to discuss the financial performance of quarter ended June 30th, 2021. We hope all of you and your loved ones are healthy and safe in the wake of ongoing pandemic, and the recent downward trajectory on COVID-19 cases is certainly a good sign, and we sincerely hope that the pandemic gets over really soon. I hope everyone must have got an opportunity to go through our financial results and investor presentation, which has been uploaded on the stock exchange as well as on our company website. For the benefit of all the participants, I would like to discuss about the company in brief initially, followed by the financial highlights for the quarter, which will be shared by our CFO, Ms. Komal Gupta. Windlas Biotech is among the top 5 players in the domestic pharmaceutical formulations, contract development and manufacturing industry in India in terms of revenue. With over 2 decades of experience in manufacturing both solid and liquid pharmaceutical dosage forms and significant experience in providing specialized capabilities, including high potency, controlled substances and low solubility products, the company provides a comprehensive range of CDMO services ranging from product discovery, development, licensing, commercial manufacturing of generic products, including complex generics, in compliance with the current good manufacturing practices and with focus on improved safety, efficacy and cost. The company also has a growing trade generics business through 700 plus stockists and distributors across India and is also present in exports to ROW markets. I will first take you through the company's CDMO business. This vertical is focused on providing products and services across diverse range of pharmaceutical and nutraceutical generic products. The company provides CDMO services and products ranging from discovery, development, licensing, commercial manufacturing and complex products in compliance with GMP, and such products are sold to Indian and foreign pharma MNCs who market the products under their own brand names. The company has consistently maintained strong and long-lasting relationships with the leading Indian pharma companies and has provided CDMO services to 7 of the top 10 Indian formulation pharma companies. CDMO vertical contributed roughly around 85% to the consolidated revenue for FY21. The company's well-diversified product portfolio predominantly overlaps with the fast-growing chronic therapies and high-margin complex generics products. Chronic and subchronic products contributed 60% and acute contributed 40% of the total revenue from operations for FY21. Similarly, complex generic contributed 68% and conventional products and others contributed remaining 32% of total revenue from operations for FY21. Number of CDMO products catered increased at a CAGR of 23% between FY19 and 21 to reach 1,364 as of FY21. The company's CDMO revenue grew at a robust 19% CAGR between the same period to reach 362 crores as of FY21. Largely driven by the rapid pace of customer addition to reach 204 customers by the end of fiscal 21. Key factors led to expansion of customer base are addition of multinational and domestic customers over the years, product excellence, which includes dosage innovation, developing complex generic products, manufacturing excellence, which includes a delivery track record, responsiveness, quality, and technical standards while planning capital expenditure and investments in specialized services and equipments for dedicated infrastructure. Our highest customers contribution reduced from 12.3% in FY19 to about 11% in FY21. We are witnessing multiple industry tailwinds in CDMO vertical. Globally, one-third of the R&D outsourced to CDMO companies in formulation segment, and India is emerging as a key player in the CDMO segment. Reasons for outsourcing by pharma companies are flexibility and reduced cost in the business model of large pharma companies, growing demand for generics and biologics, the rise in the number of drug approvals, and end-to-end service and technical specialties of contract manufacturers, and increase in off-patent products to aid the outsourcing segment. India stands out to be the biggest beneficiary for this outsourcing, driven by technical expertise, cost efficiencies, globally accepted manufacturing standards and infrastructure. And within India, the consolidation in CDMO industry, driven by need for providing a better and wider portfolio of services, will further strengthen the company's position. The company is foraying into injectable dosages, which will complement the existing CDMO offerings in oral solids and liquids, and will enable us to achieve higher margins. The company has planned rupees 50 crores brownfield capex project at Dehradun Plant 2 for this business, which is primarily aimed towards liquid vials and lyophilized vials. And the company is expecting economies of scale and improved margins once this facility comes online. I will now take you through trade generics and OTC business. This vertical contributed roughly around 10% to the consolidated revenue for FY21. It consists of trade generic products, OTC brands, which include nutraceutical health supplement products. And these products are drugs for which patents are already expired and typically used as substitute to the branded expensive generic medicines. In this vertical, our products are sold to distributors directly, and there is no promotion to doctors by medical representatives. As of FY21, the company distributed through 700 plus stockists and distributors spread across 15 states. This vertical is the fastest growing vertical for the company and has a CAGR of about 27% between FY19 and 21, with a number of brands on a CAGR basis growing faster than revenue at 30%. The main driver for this growth are lower cost and similar quality compared to branded generics and growing penetration in rural areas. Going forward, the company is expected to witness a similar growth rate in this vertical, driven by increase in width of product portfolio as well as expansion in terms of geographic locations covered. I will now take you through the exports business. The exports vertical contributed roughly around 5% to the consolidated revenue for FY21. And this vertical is engaged in identifying high growth opportunities in semi-regulated, international markets, and select regulated markets. The motive is to develop and register product applications in order to obtain market authorizations for medicines and health supplements. Subsequently, such products are sold to pharma companies and pharmacies in respective markets. We remain confident of overcoming the near-term challenges. The company, which is one of the top 5 CDMO players in terms of revenue, continues to leverage its strong position to diversify, value add, and expand the value proposition. The growth trajectory is expected to be robust, driven by innovative products, available capacity, and growth in the customer base as well as wallet share increase. Lastly, I would like to thank the investors and bankers for showing their confidence in the company and making IPO a great success with oversubscription of over 22.4x. I would like to also thank customers, suppliers, employees, and all other vendors and stakeholders for their valued support and service. The company and its management remain committed to create value for stakeholders going forward. With this, let me invite Ms. Komal Gupta, our CFO, for the financial performance highlights.
Thank you, Hitesh. I'll now take you through consolidated financials and operational highlights. First, I would like to highlight that given the nature of the business company operates in, the company's performance should be evaluated on annual basis and not on quarterly basis. The company reported a resilient performance despite the multiple headwinds. On a consolidated basis, revenue from operations stood at 111 crores as against 102.3 crores, a growth of 8.5% YOY. However, considering the impact of shift in revenue of rupees 7 crores from Q4 FY20 to Q1 FY21, the revenue growth would be 16.5% YOY. The revenue growth is not reflecting the industry growth trends due to the fact that industry growth was driven largely by antibiotics on account of COVID-19 second wave, whereas we are not present in that therapeutic area. So to that extent, we have not been able to participate in that growth trend. The EBITDA margins stood for the quarter at 11.5% as against 13.4% YOY. The company also incurred rupees 0.4 crores ESOP related expenses during the quarter. Adjusted profit after tax stood at rupees 6.7 crores as against 5.3 crores, up 26.4% YOY. Adjustments in FY21 PAT include goodwill write-off on account of acquisition of Windlas Healthcare and tax benefit due to merger with Windlas Healthcare. I'll now take you through vertical-wise highlights. CDMO vertical highlights. Q1 revenue for the CDMO vertical stood at 95.7 crores, up 9% YOY, led to a pickup in COVID-19 related therapies. CDMO vertical contributed approximately 86% to the consolidated revenue. Trade generics vertical Q1 revenue stood at 12.3 crores, up 37% YOY. Trade generics vertical contributed approximately 11% to the consolidated revenue. Exports vertical highlights. Our Q1 revenue for the exports vertical stood at 2.2 crores, down 58% YOY, mainly on account of disruptions in the supply chain. The exports vertical contributed approximately 2% to the consolidated revenue. The company has made repayment of rupees 20 crores loans in August 2021 from the IPO proceeds, further strengthening the company's balance sheet. The company has utilized rupees 45 crores from IPO proceeds for the various activities mentioned in the RHP out of rupees 153.3 crores, roughly translating into 29% IPO proceeds utilization. The company is planning to utilize the entire proceeds by December 2022, which will further strengthen the company's value proposition while maintaining the strong balance sheet. We can now begin the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from JMPMS. Please go ahead.
Yeah, thank you for taking my question. So my question is, if I go through the presentation, it is elaborate and very extensive, and congrats on that. The number of clients that we've added and the number of brands that we added has consistently been higher than the sales growth. I mean, if I simply look at the revenue per brand or the revenue per customer, it's basically been coming down. Just to understand, do we, specifically like the last couple of years, has there been more customer addition towards the end of the year, and of course there's COVID, and therefore your customer addition does not necessarily reflect the actual potential per customer in terms of growth?
Sir, if I was to take your question, for us, if you see the Indian pharma market, the top 50 companies have a much larger share in the market, and beyond that, then this starts to come down, and beyond top 100, the size of each company is much smaller. So, our customer profile also reflects the same. So, it is not necessary that every customer, looking at the revenue per customer is probably not the right metric, is what I want to say, because different customers will have different potential. And as you also correctly said, that depending on the time when they get introduced, the number might be higher, but they might not get the full year of revenue contribution. So, I hope this somewhat answers the question.
Sure. And I mean, on the industry side, you talked about, 30% outsourcing, primarily happening globally. I mean, what could be the kind of growth driver and what should we expect in terms of growth for the industry and growth for the company? If you can give some color with respect to, what is the outsourcing pie in India and whether, you see this opportunity also moving up more nearing the global side.
Sure. So what we have seen through our primary market search that was done a few months ago is that large Indian pharma players are not doing new capex for their India business and are relying on outsourcing partners like Windlas and others. So there is an organic growth of those brands, which is essentially coming to the outsourcing industry. There is new launches. So if you look at every year, about 4% of the growth, 3 to 4% comes from new launches. And out of that, almost 70% of, that new launches are coming from, again, outsourced partners like Windlas. So more and more growth is coming from the outsourcing industry. Our numbers, which are a few months old, seem to suggest that if the Indian pharma market grows between 9 to 11%, the outsourcing industry for India market will probably grow somewhere between close to 13 to 14%. Those are the numbers that we got from industry reports. Sure.
And sir, with respect to the margins and complexity, I think we have clearly moved up the margins to some extent, and also we continue to grab more market share on the complex side as well as targeting more on the chronic side. Where do we see the margins move from here, say, the next couple of years?
So, yeah. Okay. So in terms of material margin, I'm not sure that we talk about the couple of years, but we are in the coming 3 to 4 years, what we expect is there are several factors that we can consider. First is the injectables business that we are going to start very soon. That is a high margin business. Second is our trade generics and exports division that we have has higher margin than our CDMO business, and because these are low base businesses, we expect them to grow at a higher pace and to contribute more in the overall revenue, which means that some material margin would be coming from there. And third is currently we have capacity utilization which is not at the peak. So as we reach the peak capacity utilization in all the plants that we have, like recently we have acquired plant 4, which is the Windlas Healthcare facility, and our plant 3, which we have recently repurposed for from cephalosporin OSD to the regular drug business. So as we increase the capacity utilization in these plants, the operational efficiencies will kick in. So with all these factors, we see in the long term the overall profitability margin growing for the business.
So what is the current utilization then?
The current utilization is in the range of about 36%.
Thanks a lot. I'll join back.
Thank you.
Thank you. A reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Manish Kanodia from MK Fincap. Please go ahead.
Yeah, thanks for the opportunity, sir. I have 2-3 questions. So firstly, in the investor presentation, you have mentioned about this R&D outsourcing and domestic CDMO opportunities in detail. Can you please share at what CAGR we expect to grow our CDMO business in the next 3 to 5 years, and also what kind of market share we are expecting will have in the next 3 to 5 years?
Sure. So this CDMO market is unfortunately not covered by any of the market reports outright. And in the market study that we got done, it was estimated through a lot of primary research. The expectation is that market will, which is the total outsourcing market is about 20,000 crores in India today. And this is both CDMO as well as CMO, and is expected to roughly double in 5 years to about 40,000 crores. In terms of our long-term view, we are obviously one of the leading players, and we expect to grow slightly faster than market. So our goal is to definitely target a better growth profile than the overall market growth. And in the long run, this is where I think we should we are expecting ourselves to be as well.
Understood. And so secondly, is the company planning to increase the share of chronic and subchronic therapy? And if yes, how the share of these therapies would look like in the longer term?
Sure. So currently, as you see, almost 60% of our business is in the chronic and subchronic therapeutic areas. There is in these areas we are focused more on diabetes, cardiovascular, neuropsychiatry, gastrointestinal, these kind of disease therapeutic segments. And we are looking to, a lot of our pipeline products or new product development is focused on these therapeutic areas only. And, whether doing value-added generics in this space or bringing new fixed dose combinations for products which are coming off patent in this domain, those are the ones that we are also bringing on, and therefore targeting more momentum in this chronic and subchronic space.
Understood. And then lastly, is it possible to share margins and return ratios separately for our segments like CDMO, trade generics, and exports?
Actually, as these are, so we have the same plants. The 4 plants can actually serve all the 3 businesses: CDMO, exports, as well as trade generics. So that's why it is we only look at the material margin business-wise, but other than that we don't really see, because it's actually more of a fixed cost allocation for all the businesses instead of really business-wise tracking. So it doesn't really make that much sense, so to say.
But in terms of margins, can you can you throw some light on ballpark figures?
So the trade generics has about 5 to 7 higher margin than the regular CDMO business, the material margin, and the exports is even 4-5% higher than trade generics.
Oh, understood. Okay, thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Akshay Jain from Jain Capital. Please go ahead.
Thank you. Good afternoon. I have a couple of questions. Firstly, how much growth in revenue share is expected from generic business, and how are the inquiries and we planning to expand our offerings in the entire domestic market going forward, or we would like to penetrate further in the 15 states where we are existing for trade generic business?
So, sir, can you just say your first question was how much growth?
How much growth and revenue share is expected from generic business, and how are the inquiries and conversions happening in that business?
Sure. So this is in this business. Basically, what is happening is that we are targeting the B and C class towns in India. As you know, there are only 400 odd towns where the population is more than 1 lakh, and enough doctors are there. So the branded generic model works out with the medical reps in those places. But there are 6.5 lakh villages and kasbas, very deep interiors, where even physicians are not there, and there is access issue regarding drugs. So in these areas, the drugs are sold directly through the distribution channel. So the stockist and then the retailer. And this is where trade generics vertical of ours is also existing. So in this vertical, we have been building strength in the sort of northern states so far. Now we are looking to expand more, and it's a nucleation and growth model. So we start somewhere and then start expanding around that territory and going deeper and deeper into the hinterland of that area. We have seen, in terms of opportunity, it is there, vast opportunity is there. And we are trying to follow the population density and the market needs from the state's perspective. So that's how we have been, expanding in this vertical. Most of the time, the expansion is twofold. One is geographic, as you picked up, but the second is also around product portfolio. So because we are working directly with the stockists who are just above the retailer, we are trying to see, what else can the stockist sell? What is the credit profile of that, stockist and retailer? And that's how we are, building our product portfolio and launching more products to go along. I hope I answered your question, in terms of how the growth and market share is developed. And your second question was, sir?
The second question pertains to the expansion of our offerings into entire domestic market going forward, or we would restrict itself to the 15 states where we are currently present in trade generic business.
Yeah. So, sir, we are looking to strengthen the states that we have opened, and we believe that there is a lot more, sort of opportunity to grow within these. And it is as we get good talent and local expertise, then only we would want to open more states and get into those. So that is how we are building the business.
Okay. Great. Thank you so much. That's all from
you.
Thank you. The next question is from the line of Anupam Agarwal from Lucky Investments. Please go ahead.
Yeah, hi, good afternoon, and thank you for the opportunity. Sir, in your opening remarks, you mentioned about a 50 crore capex for the injectable plant. Can you give us the economics for the plant as to by when it will be operational, and at peak level of utilization, what can be the sales from that plant?
Sure, sir. The injectable facility, after the construction requires a period of media fill and validation, and the time taken is slightly longer than typical oral solids. We are expecting, if everything goes smoothly and no disruptions due to any unanticipated things, that our first commercial batch should roll out in Feb of 23 from this facility. In this space, the asset turns are much lower. So, oral solids, we have an asset turn of about 4.5, but in this space, the asset turn is more around 1.2 to 1.3, but the margins are much better. So that is why, the peak utilization on a 50 crore capex would be somewhere around 1.2 times that, so 70 crore.
Understood. And this will be coming in by FY24, all of it, mainly. Will we be able to ramp up the facility in the first year itself?
No, so there will be a gradual ramp, but obviously our efforts will be to see how much capacity we can tie early on as much as possible. We have the time, but yes, but there would still be, sort of a phase-wise ramp up that will happen.
Right. Have we identified products in the space, in the injectable space for the plant?
Yes.
Have we gotten orders? Have we gotten orders from large pharma players?
No. So as I mentioned, the plant installation itself and qualification will take some time. So Feb of 23 is when we are looking to do the first commercialization. It will, commercialize. It will cater to all three of our divisions. So exports, trade generics, and CDMO. And we are looking to, take advantage of this facility, just like all other facilities, and build business on all three verticals. To this.
Understood. On the trade generics business, if you could, sir, give us how much is the domestic trade generic market on an overall level, and how much would be the top 3-4 players taking the market share?
So, sir, it's very, again, not covered. This kind of trade generics market is not very well covered by either AIOCD data or the, IMS data, IQVIA data. So, at the just general industry estimates is that this is somewhere in the range of 25 to 30,000 crores. And, please take it with a pinch of salt. And the largest player is, of course, Cipla and Alchem, and then we have Leaford, which is almost 1,500 crores, Laborate. So these are some of the more prominent names which have built a significant business.
Understood. So lastly, from the IPO proceeds, I missed your part. From the 150 crores that we raised, how much has been deployed for debt repayment, and how much are we looking to do for the rest of the money?
So we have about 45 crores is what we have utilized till now. 20 crores was for the debt repayment, and 25 crores is for the general corporate purposes that we have utilized by now. So about 29% we have utilized.
And for the balance money, we intend to go for the brownfield, and what is the rest of the purpose?
So there is about 48 kind of a crore amount which will be used for increase in working capital, and about 50 crores will be for injectables and small portion of plant 4 expansion. Rest is for general corporate purposes, in addition to 20 crores that we have already utilized for the loan repayment.
Understood. Sir, on the CDMO business, if you can quantify how much is the overall market that we want to cover, let's say across therapies in the chronic space, what would be the macro picture as to the market opportunity for us?
It's the CDMO market opportunity, as I mentioned, is somewhere around 20,000 crores today, expecting to be doubled in 5 years, as per the industry report, that we got. In terms of growth, it will come by addition of dosage forms. So we are doing already, oral solids to a large extent, and liquids in 360 crores that we do. but we don't have a lot of other dosage forms like protein powders, like hormones, steroids, ointments, soft gels. Injectable is the one that we are adding now, in an organic manner. But there is a lot of room to grow by expanding laterally and then bringing new innovative products in those dosage forms for customers. So this is how we are looking to, at least begin with injectables.
Understood. So just one last question. So you mentioned that if IPM grows by 9 to 11%, we'll be growing by about 13-14%. And the other two businesses, which is export and trade generics, will go much faster at 30-35%. What should be the sales mix, let's say 3 to 5 years down the line, if all numbers pan out as planned?
Okay, so let me slightly mention this, that 5 years hence, we are roughly looking to double our CDMO business, triple the trade generics business, and quadruple the exports business. This is the sort of internal goal that we are pushing for. And so the sales mix will therefore happen accordingly, because the smaller businesses. Yeah.
I'll do the math. Thank you. This helps a lot. Thank you so much, and I'm wishing you all the best.
Thank you.
Thank you. Participants, to ask a question, please press star and 1 now. The next question is from the line of Akash Mehta from Kapil Investments. Please go ahead.
Hello, good afternoon. Most of my other questions have been answered. I just had a small question in relation to the exports. I think you mentioned the exports account for about 5%. So it's a very small business for the company, but can you share how are the gross margins and return ratios for the business? And can we expect this business to contribute about 8 to 10% in the next 3 to 5 years?
So in terms of the growth, Akash, as Hitesh mentioned, about 5 years we expect the business to quadruple. So broadly it would be in the range that you are talking about if everything goes well. Then in terms of the margins, as I mentioned, the margins for the exports business, we don't track EBITDA or profitability margin separately, but material margin wise, the exports business is the highest margin business for us. Trade generics has higher margins than the domestic CDMO, and exports is even 4-5% higher than the trade generics segment.
Okay. So it can get to those 8 to 10% levels in the next 3 to 5 years?
Yeah, that's correct.
Okay, that's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Aditi Sawant from ABM Advisors. Please go ahead.
Yeah, hi. Thank you so much for the opportunity. I have only one question. As the company is zero net debt company, are we planning to share the profits with the shareholders?
Thank you for that question, ma'am. We are, looking to have a dividend policy, and in fact, at this meeting we had a proposal, and our board asked us to get some benchmarking data for our sized company in terms of the range, and we are looking forward to in our next quarter, when we come for the earnings call for next quarter, to have a policy in place with some guidance on that.
Okay. We'll wait for that information. Thank you.
Thank you. Before we take the next question, a reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Asad, an individual investor. Please go ahead.
Hi, sir. Good afternoon. My question is, the employee cost has gone up. Is it likely to come down very soon?
So the employee cost increase is caused by several factors. like the plant 3 that was not operational earlier has become operational. So fixed cost that way for that plant has increased. There is 4 million of ESOP reserve for the employee stock option scheme that we have declared last year. So 4 million is impact of that, and about 2 million is the director's salary proportion, 3% of profit and things like these. So how it will pan out is, cost-wise there might not be reduction. Where the profitability will grow will be from operational efficiencies kicking in as we increase the capacity utilization and the revenue numbers grow.
Okay, ma'am. That would answer my question. I had one more question. How much cost will we be saving by repayment of the loan, the 20 crore what we have repaid?
Okay. On 20 crore, we had about 8% of was the 8% per annum was the interest cost, which we will be saving. But the loan was taken in March of FY21. So there is not a very, in so like to like YOY numbers, you won't see a reduction coming in. It's just the additional cost that would have come in the books that won't come anymore.
Okay, ma'am. Ma'am, my last question is, as we know that the margin in the exports are more, are they going to increase?
We already work at a very high margin. We are not in the regulated markets like US or Europe. We work in the ROW markets. In that range, we already are working at a very good material margin percentages. So we expect to continue to work in that kind of margin area.
Okay, ma'am. Thank you, ma'am. That's it from me.
Thank you.
Thank you. Participants, to ask a question, please press star and 1. As there are no further questions from the participants, I now hand over the conference over to Mr. Hitesh Windlas for closing comments.
Thank you very much, everyone, for giving us this opportunity to speak about our business with you. We are, a young company, focused on doing a great job, and very much appreciate your questions and support. Please do reach out to our IR consultants, strategic growth advisors, or us directly should you have any further queries. Thank you very much again, and stay safe.
Sorry to interrupt you, Mr. Hitesh, but we have one more participant in the queue. Shall I promote the participant? The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead. Nitin Agarwal, please go ahead with a question. Your line is unmuted. Mr. Nitin Agarwal, we cannot hear you, sir. As there is no response from the participant, will move. Thank you so much. On behalf of Windlas Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.